Do you love leaving money on the table? Well, who of us does, right? But it's surprising how many of us as American taxpayers seem to love exactly that when it comes to our tax bill from the IRS. We work with a lot of people, and especially a lot of entrepreneurs here at Norberg Wealth Management. And in today's video, I'm going to go through how you, as a business owner, can take advantage of 3 commonly left on the table tax-saving techniques or deductions that you might want to be aware of. You may already know about these, but best to review, make sure you're taking the most advantage of them, and that's exactly what we're going to talk about here today. Hi, I'm John Norberg, and welcome to the Financial Prof Series. So 3 top, shall we say, left on the table money items, right? 3 underused deductions, as I've seen come across my desk time and time again. If they're being taken advantage of at all, just simply don't seem to be to their fullest extent, and with really no good reason or no intentionality behind it, right? Because it's one thing if you have intentionality behind why you're not taking advantage of a deduction, and while it's not literally impossible, it probably is darn near, if not in fact, to take advantage of every single deduction in the tax code. There are a lot of good reasons not to take a deduction, but what we're going to do today is talk about 3 that most business owners, most entrepreneurs are probably going to be eligible for, and where I see them being underused. All right, so number 1, this is a pretty easy one, mileage, right? Now, let's start with something simple. There is no cap on mileage, right? And your CPA has probably not told you that there is, although I have run across a few who have mentioned something along those lines, and maybe it's been misunderstood by a client, but there is no cap on deductible mileage. As long as it's for business purposes, you can deduct 50,000 or heck, 100,000 miles for all I care. But the thing is, it has to be for business purposes. So if you're a real estate professional, chances are you're driving all over the country probably trying to find clients' homes or selling clients' homes, showing clients' homes. There is no limit to what you can deduct if it's in pursuit of business, right? So number 1 is mileage. Make sure you're tracking those trips. And there are a couple of different ways to do that. That's not for this video, but the IRS says that for this past tax year that just wrapped up, so the one you're probably doing your taxes for right now or about to, it was 67 cents per mile, right? And that rate did go up just a little bit this year too, here headed into 2025, so it'll be even a little better. Anyway, mileage is a common one. I see it underused all the time, under-recognized. Find yourself a good app, or if you really want, a pen and a paper, and take advantage of your phone's calculator and Google Maps if that's your preferred app, and figure out what your mileage is. Make sure you record it, make sure you record what it was for. Let your accountant take care of the rest. All right, so number 2, HSA, or health savings account. Now, not everybody is going to be eligible for this, right? But even if you're not a business owner, you're probably going to be eligible for it if you have a high deductible health plan, right? And what is an HSA? Well, quite simply put, it's a health savings account. You put money into it, you can deduct that money from your taxable income. It grows tax-free, and it distributes tax-free on the other end. Now, one of the big advantages of the HSA, we've talked about this in previous videos, is if you incur an eligible expense, which is usually a medical expense of some kind, then you can distribute money then to pay for it, or better yet, you simply save documentation such as payment receipts for those medical invoices, and then continue to grow that HSA by paying out of pocket when the expense is incurred instead. Because here's the thing, once you get to age 65, you can distribute those those HSAs for any purpose whatsoever. Now, it's not going to be tax-free if it's for a non-health related expense. It's going to be treated like a traditional IRA in that case, in which is to say that it's going to be taxed at ordinary income rates. But as long as you're 65 or better, you're not going to have to pay a 10% penalty, which is typically the case if you distribute from one of those accounts in an improper manner. Say, for instance, for a non-health related expense in the case of the HSA, unless you're 65 or better, right? So again, number 2, HSA. For a married couple, that max is $8,300 per year. Let's make sure we're taking full advantage of that, right? The retirement plan. This is number 3, retirement plan. Most of us contribute to one, right? Or at least some kind of retirement savings, and hopefully you're doing the same. Now, here's the thing. If you're an entrepreneur and you have a retirement plan for your business, good for you. You're ahead of a lot of other entrepreneurs. But the question is this the best business plan for your business, I should say? So a lot of entrepreneurs that I see work with a SEP IRA to begin with, right? A SEP IRA. The reason that they do so is because it's simple. It's meant to be that. But the thing is, when you get to a certain point, you're going to find that that SEP IRA is going to get pretty expensive pretty fast once you start getting some good employees that start to get tenure And for some businesses, this takes longer. Some businesses, it happens fairly quickly. But you're going to have to start matching them correlative to what you're putting in, depending on their tenure, right? Now, if this is you, and you've had some good employees with you for a little while and you're still using a SEP IRA, maybe this is the year to look into, okay, maybe it's time for a 401k or a simple IRA, or maybe you have a simple IRA. Now, that's been working well enough for you, but it's gotten to a point where, okay, our business is growing, we've got a few dozen employees, would maybe a 401k be a better option? I can put away more money in a 401k. This is absolutely true. Or maybe you have a 401k and maybe it's been doing just fine for you, but you're wondering, well, what else is there? Is it only $30,000 that I can put away in a 401k? Well, actually, not only is it a little more than that, it can be as much as hundreds of thousands of dollars between a 401k and a cash balance plan, right? So if you get a 401k, a profit sharing, and a cash balance plan all working together, you can actually put away literally hundreds of thousands of dollars per year into your retirement savings. If you want to know how that works, we discussed this in another video on cash balance plans, but again, I would be happy to talk about it with you and discuss your specific situation. So again, number 3, take a look at your employer-sponsored retirement plan. And if indeed you are the plan sponsor, make sure that it's still the best plan for you. And if not, time to talk to your financial advisor or give us a call here at Norberg Wealth Management. We're happy to help. And in the meantime, I'll see you out there.